Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
In this episode of Excess Returns, Jack and I discuss some of the pitfalls of backtesting investment strategies and the things investors should pay attention to and the questions they should ask when looking at the results of backtests. Thank you for listening. We hope you enjoy the discussion. All right, today we're going to talk about backtesting. And backtesting really over the last, I'd say 10 or 15 years has become much more prevalent in the investment management business. I think with the advent of computerized strategies, factor-based investing, and a lot of the work done out of the academic world that rely or do these backtests, you're seeing, or we've seen more and more of these. So I think today what we wanted to do was discuss the pitfalls of backtesting, and then also I think what investors want to look at and how they should assess and the things they should realize when they see a backtest. And this is largely, we're going to play off an article you wrote from, in the fall last year called The Pitfalls of Backtesting. But maybe to start, do you want to sort of just shake out what we have seen, what we're seeing in terms of backtesting in the money management and asset management world, and some of the things that maybe investors want to sort of think about at a high level when they see these things?
Yeah, as you said, as firms are launching so many quant products these days, you're seeing many backtests. And one of the interesting things about backtests is if you look over time and say how many active managers outperform the S&P 500, the number is something like 80% underperform. If you look at backtests, 100% outperform. So obviously something is going on with backtests that is leading them all to show successful results, and then those results are not translating into the real world. So what we wanted to talk about today is some things to look at in backtests to sort of judge the quality of them, to judge how much you should rely on them. But I think the first thing is everybody's default in terms of backtest should be, I should ignore this backtest. So when a backtest is put in front of you, your default setting should be, this is not of value to me. And then as you build up and look at it, maybe it will be of value, but most of them are not of value. And so if you can start in that default setting, sometimes people see these great results and they start in the default setting of, wow, this is an amazing strategy, I should follow this. If you can set your default setting to, this is not a worthwhile test, and then work your way up, I think that's a better way to do it, because so many of these backtests have issues that if you start in that negative side, I think it works out better.
Yeah, and by the way, just for disclosure purposes, a lot of the strategies that we run on Validea, we are relying to some extent on the backtests that are done either in the academic world or in these books or academic papers. But then what we do is we sort of capture the strategy and we try to run it and verify it independently. So it's not that we don't utilize backtests or look at backtests and even backtest ourselves. But I think there's a difference between extracting a strategy that's being written about and backtested and implementing it than, let's say, trying to data mine or create a brand new strategy and running it backwards.
Right. Our goal with our strategies is always to try to follow published strategies exactly as they're published. And so we try not to run into these traps of constantly tweaking the test to try to make things better. We try to, follow exactly what's published. But having said that, we have to verify that whoever did that test followed the proper rules, because they could, as much as we're trying to avoid this stuff, if they did it, it carries on to us. And
right.
So we'll talk about some of the issues with backtesting, but we've tried to follow strategies where those issues are either minimized or not present.
Mm-hmm. So you came up with 5 things that you think, and these are pretty high level points, but that, an investor would want to look at or think about at least when a backtest is put in front of them. And the first one was, does the test account for human emotions? So what did you mean by that?
Yeah, so I'm not talking about the test itself, because obviously the test itself cannot account for human emotions. It's a quantitative
Right.
test. What I'm talking about is, essentially what I'm talking about is, can you stick with this strategy? And so as you analyze back-tested results, sometimes you'll see these really great returns at the end, but you'll see a lot of volatility in the middle. And if an actual investor could not stick with this strategy, they're not going to see the returns at the end. So that's what I'm getting at is, as much as people like to look at the ending return, the ride along the way that got you to that ending return is really important.
Right. So would the investor actually be able to stick with a, you might have a strategy that, let's say, has a 20% annualized return over whatever period of time, let's say a decade or, 20-year period. But if the volatility of that strategy was double the market, then the reality is the vast majority of investors aren't going to be able to stick with that type of strategy. So you want to kind of look, I think, underneath at the risk statistics as well with any of these back tests.
Right. And also when it's underperforming by 20% in a year or 30% in a year, that's very hard for anybody to stick with. And so I think it's important just to look at the totality of it. And
right.
The more the returns are sort of in the middle, the easier it is to stick with. The more you've got the 30% underperformance and then the 30% outperformance, the more difficult it is to stick with.
By the way, I think it probably goes the other way as well in terms of strategies looking a lot less risky on paper, and then obviously something blowing up and, then the floor falls out from under the strategies. Because a lot of these back tests, what they're trying to show is better returns and lower risk. And so you also got to be mindful of that, is that, if you see something, and I think we'll talk about this maybe in another one of the points, maybe I'm jumping ahead a little bit, but, if something looks too good to be true or looks to be like a great performing strategy with half the risk of the market, that's probably unlikely as well.
Yeah, and that goes to something we're going to talk to in a little bit. But if you test a strategy in a certain period and it's a short period of time, you might see totally different characteristics than what the strategy will show over the long term. So if I were to test, a large cap growth strategy in the past decade, I'm going to see great returns. I'm going to see not that much volatility. It's going to look like the greatest strategy ever. But if I widen that out and I look at the long term, well, large cap growth is not a great place to be invested in the long term. So it's important that you look at the period that's being covered and understand what happened in that period and understand how that impacts the strategy you're looking at.
Right. Okay. The second point that you made was, to ask the question if a strategy has actually sound economic reasoning behind it.
Yeah. If you see something work, there should be some sort of reason it worked. There's been some academic tests where they, just to prove this point, they did some data mining and they just went through and ran every single variable in their fundamental database through, an optimizer and came up with a strategy that outperformed every other strategy. But when you looked at the results that came out, the actual fundamental criteria they were using made no sense whatsoever. And that was the intent of it. The intent of it was to show you can build any strategy that looks great and you can combine a bunch of variables together. But at the end of the day, it has to make sense. There has to be some reason this should work. So something like value, for instance, there's a reason value should work. Paying less for a unit of earnings or a unit of cash flow over time, that should work. There's a reason for that. But some other strategies, you don't see a reason at all. And so it's just important there's some sort of economic basis for what you're seeing.
And just to digress for a minute, the concept of data mining is, for those that may not know, it's, when someone basically puts together a number of variables in a back test that really have nothing to do with each other, but they're just picking the ones that look best and look most optimal in the back test. They're not really based on anything other than, a data mining exercise. So I think that, and a lot of back tests are done that way. I mean, people are looking at, hundreds and hundreds of variables to try to find the mix of variables that may not have anything to do with each other that sort of make the most sense. And that can be a very slippery slope when constructing these investment strategies, because you want to try to not be doing that, because the fact is that there's randomness that those variables are working. There's not really anything they're based on.
Yeah, there's this saying that if you torture the data enough, it'll confess. And that's what data mining is. Data mining is just continue to run tests over and over and over again, continue to throw variables in and out. Just do whatever it takes to find something that works. And that can be, those types of strategies that are data mined never work going forward. They always look great in the history and they never work going forward. So it's just important to try to avoid that.
The third thing that you discussed was, the period of time that the back test covers. So does the back test cover a long enough period of time for it to be statistically significant?
Yeah, you want to see at least 30 years and preferably longer than that. And what we talked about before is a good example of that. If I want to test a large cap growth strategy in the past decade, it's going to look tremendous. If I want to test a value strategy in the past decade, it's going to lead to the conclusion that value doesn't work at all. And so the period you cover is really important. And even very long periods can still be missing things. So as an example, even if you test back 30 years right now, you don't have the high interest rates and the inflation of the 70s in your results. And so what if my strategy's one weakness is in those periods, where there's high inflation and high rates,
right?
My strategy is not going to work. Well, if I test back 30 years right now, I'm not going to know that. And so the more data you have, the better, I think, as you look at this, because the more different market environments you encounter and the more you can see the flaws in strategies.
I'll always remember I went to, it was one of the Ritholtz conferences, and actually Corey Hofstein, who's somebody we've gotten to know over the years, was there. And they were talking about backtests. And I remember this will always stay with me. He said, and he was kind of discussing this as like an advisor, if you were an advisor or let's say an investment consultant. But he said, if someone brings you a backtest and in the backtest, there's no periods of underperformance, the first thing you should tell them is you need to go back and test it over a longer period of time, because no strategy works in all periods of time. And your point here is really what Corey, I think, was saying, is that, you got to test it over a very long period of time, because inevitably there will be a period when that strategy doesn't work, even in the back test. And being able to see that and understand it and think about it and understand sort of the why behind it, that's very important.
Yeah, and that actually plays into our point number 4, which was, does the test show periods where the strategy struggles? And for me, when I look at a back test, I don't look at the long-term return as the first thing I look at. The first thing I do is dig in and say, where was it bad? Because first of all, if like you said, Corey said, if there's nowhere that it's bad, it's obviously not a valid test and you can throw it out. And it might be because they didn't cover a large enough period of time. It might be because they just data mined it and they just kept developing strategies until they found something that worked all the time. But there always should be periods that it struggles. And also, to me, those periods should be periods where you expect it to struggle. So if somebody comes to me with a value strategy that in the past 10 years has done really well, my first reaction is it's not really a value strategy. So I want to see what the strategy is being presented as is what it actually is. So during a period where large cap growth is dominating, a value strategy should not do well. So to me, it's a negative if the value strategy has done well in the past decade, because it's not a value strategy. And that means when value comes back, if what I want is a value strategy, I'm probably not going to get value in the way I expect it.
Right. And by the way, when we're talking value here, we're talking in the traditional like academic sense of value. There are different ways to define value. So, but all right. And the fifth point is that does the back test assume some type of knowledge that wasn't available or wouldn't have been known at the time that you're back testing back to? So this is an interesting one. If you want to kind of
this is one of the hardest parts about backtesting, because you can't unknow what you already know. And so I know that over the past 30 years, interest rates have been consistently falling. I know that over this past decade, value has struggled. So when I'm building a test, that's in the back of my mind. And as I develop my criteria, I have a tendency to want to develop criteria that's going to do well in this based on these things I already know. It's really hard to overcome that, because you can't unknow what you know. And so nobody's going to go back right now and say, let me test a strategy that does well when interest rates, over the past 30 years when interest rates are rising, because it's going to do poorly. And so trying to limit that, trying to some degree unknow what you already know is a challenge for anybody running tests. But it's also a bias that shows up in these tests, because everybody's knowledge of what already happened tends to reflect itself in the criteria of a backtest.
I'm just curious, does that relate at all to the AQR Superstar study, where they looked at like the performance of Buffett and Lynch and Bill Gross, and then they tried to regress their performance to factors?
To some extent it does, but AQR sort of acknowledged that in the paper. AQR was not trying to say that there was no alpha for Buffett, because it can be now we know what we know now about factors tells you a lot of this was based on factors, because at the time people didn't know what we know now about factors. So it doesn't in any way, the AQR study that showed you could break down performance for people like Buffett into factors doesn't mean that you could have done that then. So I think you're right. It is reflected in there, but AQR also acknowledged that
Okay.
the goal here was not to say Buffett didn't add alpha or Buffett didn't add value. The goal was just to say, knowing what we know now, a lot of what he did can be broken down into factors.
Right. Okay. Well, I mean, so those are hopefully 5, points that you can take away from this. This isn't, and there's probably a lot of other things too when looking at back tests. This is supposed to be like a starting point for investors. I mean, I think back tests are important. They can be useful, but I also think they should be, like you said in your piece, they should be viewed with, a healthy degree of skepticism and just an understanding that, these back tests are created, and to a large extent, they're used in marketing materials and the way to try to get, investors into these strategies. But looking at them through the lens and trying to understand the pluses and minuses, I think are important for many investors, especially as more and more these factor-based and quantitative strategies are developed. Do you have anything else you'd like to share?
No, I think the general point is you should always be skeptical of backtests. And if you can do that, and if you can look at some of these points we talked about here, I think it'll serve investors really well, because the general tendency is to want to believe these things. And if you start with the general tendency not to, I think you'll be much better off.
Great. All right. Thank you guys for joining us. We appreciate it. We'll see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.